Welcome back to the Mining Pod. On today's show, we're joined by Reggie Smith, lead FinTech analyst at JP Morgan. Reggie recently put out an awesome report on Bitcoin mining stocks. We're going to go through it. We talk about mining stocks such as Marathon Digital, Cipher Mining, Cleanspark, and Riot platforms. But first, a word from our sponsors. Did you know that you can make more money by merge mining other networks? Check out makemoremoneymining.com for information on BIPs 300 and 301, a proposal to bring more revenue to Bitcoin miners through sidechains and merge mining called drive chains. Increase your mining revenues and learn more about participating in Bitcoin governance by visiting makemoremoneymining.com. Are you a miner who wants to activate Bitcoin improvements? Check out Activation.Watch. See what Bitcoin improvements the Bitcoin community, developers, and miners are considering, and show support by signaling for one of many BIPs up for consideration. Activation.Watch. Is your mining operation happening ready? Take control of your own future with the right energy strategy. Lincoin Energy Trading Platform is a tool used by miners to design, monitor, and seamlessly orchestrate sophisticated energy strategies within electricity markets such as ERCOT, New York, and PJM. Avoid penalties, participate in demand response programs, and capture hundreds of thousands of dollars per megawatt per year by deploying the right block and index strategy. Secure your competitive edge at lincoin.com. Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com. Welcome back to the Mining Pod. Today we're joined by Reggie Smith, lead FinTech analyst at JP Morgan. Welcome to the show, Reggie.
Hey, Will, thanks for having me.
Yeah, I'm really excited for this conversation. JP Morgan, yourself, and a colleague just put out a new report going through details on 4 different public mining stocks that are out there: Cleanspark, Riot, Marathon, and Cipher Mining. And of course, there's lots of different mining stocks out there, but I think this is one of the better reports we've seen in quite a while, just detailing out certain metrics that analysts and investors should care about when they're looking at this large array of Bitcoin mining stocks they're able to purchase for their portfolios. So we're going to go through all of those today. Again, just a great report. Thanks for putting that together for us. We're going to start from the top, just talk about the space itself. Why in the middle of a bear market is JP Morgan looking at our small world of Bitcoin mining?
Yeah, no, it's a great question. So we've actually been covering the space for just under 2 years. And so we were involved as one of the lead banks in the Iris Energy IPO. That was in November of 21. And so I've covered Iris Energy since December of 21, so nearly 2 years now. Been doing work on it. Me and my team, we publish 2 reports a month, kind of an end of month summary of what happened with hash rate and profitability. And then a mid-month rather, report that looks at, some of the operating metric for the leading miners. And in doing that, we spent a fair amount of time, and it made sense to expand coverage. And so we were covering one name, and as you know, Will, like once you kind of understand the ins and outs of Bitcoin mining, you get a lot of leverage on that by adding more companies, and by picking up those additional 4 companies, it allows us to start to make more relative stock calls, and it gives us a better view of the industry and what different management teams are saying, pricing, growth in the hash rate, things like that. And so it just made sense to kind of expand coverage now. Now, obviously, you talked about the bear market in Bitcoin. When we launched coverage on Iris, like I said, December of 21, you're probably looking at a $50,000-$60,000 Bitcoin price. A lot of enthusiasm, a lot of interest. And so ideally, you're launching coverage in that type of environment. But like I said, it just made sense to expand coverage at this point. And so we rolled out, 4 new names.
Awesome. And I had one question come in from an audience member. They're wondering, why not cover all 14 or more at this point? I mean, there's even more than 14, right? There's some on
Yeah.
Canadian exchanges and stuff like that. But why limit to just these 4 names at this point?
Yeah, it's a great question. So a couple things we looked at. Obviously we're interested in market cap, and so we want to cover the larger names. But then secondarily to that, we're also looking at kind of trading activity, and so we want the names that are most actively traded. which would resonate most with our investors. And so, we get calls from time to time from smaller companies that are interested in coverage, and you got to always kind of balance the interest from institutions with the interest of the companies. And so we chose these four companies because they kind of checked off all of those boxes. They had good market cap, they had good trading activity, and that's kind of where we landed. It's a funny question. You talk about, why not cover all 14? Like I said, you have to be kind of selective there, and we're a team of two right now. And so, in these four names, five names, keeping us pretty busy. In addition to the other names that we cover. So that would be, how we think about and approach, adding coverage and selecting stocks to um, to discuss.
Gotcha. I do imagine that a lot of people are looking for JP Morgan to cover their company, so it's not surprising your phone is ringing. Okay, before we dive into metrics and really like the meat of the report itself, we have to talk about the Bitcoin ETF. I mean, there's even a headline this morning from JP Morgan, I assume some colleague, a far distant part of the bank, talking about how they expect an ETF to be approved by January 10th of next year. For listeners who aren't in the know, the SEC has been reviewing a lot of these Bitcoin ETFs for years now. There's a lot of different applications available. And it looks like after the latest loss in court for the SEC versus, I believe, Grayscale, that there might be a chance we see a Bitcoin ETF. Maybe that's hopium still, but I think it's going to happen. So let's talk about Bitcoin ETFs and what that's going to do for these Bitcoin mining stocks. I think a lot of the executives out there are wondering themselves, like, is this going to be an entirely different landscape for them in their funding, like our ATMs and all those sort of things, going to be as valuable in the future? And then what's this going to mean for investors who are going to have so many more options now with a Bitcoin ETF coming to market?
Yeah, so I don't have a view on whether or not it will get approved, or when that will happen. But we can definitely talk about potential outcomes if it were to happen, right? And so I think, the obvious impact is that it's going to increase demand, at least in the short run, for Bitcoin. And so these companies or these funds that create these ETFs are going to have to go out and buy Bitcoin to support that. Just given the supply and demand dynamics of markets and pricing, you would expect that to have a positive impact on the price of Bitcoin. Incremental demand, combined with steady supply should drive prices higher. Um, I think, when you compound that with the halving that's going to occur in April of next year, which could potentially, lower or reduce the supply of Bitcoin that's being sold by miners. Like, I can envision a scenario where, the ETF could catalyze a pretty robust rally in Bitcoin, right? So that's good. Now, a rally in Bitcoin is by and large is good for everybody in the ecosystem. Miners make more money, the rewards are worth more. So there's no disputing that. I think the fact that an ETF could potentially bring more institutional investors into the space, which again is just good for adoption, drives prices higher. I think what we don't know, or one potential negative impact, is that today, um, Riot and Marathon, two of the largest cap names in the space, are seen as kind of proxies for Bitcoin, and they're a way for institutions to kind of play Bitcoin in an indirect way. You could see a scenario, or I can envision a scenario where if there's an ETF out there, that gives institutional investors access to the asset class. You can lever it up. You can do a lot of the things that it gets you a cleaner play on Bitcoin than buying Riot or Marathon. Which, with that type of purchase, you're dealing with hash rate, you're dealing with outages and things like that. And so you could see, some of the interest in those names wane a bit as people go directly to the ETF for a cleaner exposure. It also could introduce a whole nother realm of kind of arbitrage opportunities where, it may be cheaper to buy Bitcoin outright and lever up versus, buying it indirectly through Riot or Marathon or one of the miners. And so it's something that I think we're watching and monitoring, and there are a number of different ways that it could impact the markets.
Yeah, it feels like very murky because
Yes,
like on the one hand you think like a Bitcoin ETF that's going to pump it, like that's what we're all here for, right? On the other hand, I don't know what happens with these mining stocks where again they've been used as a proxy for so
sure.
many people trying to get exposure in the space. And I'm just thinking of like even smaller investors who don't feel comfortable with a seed phrase or don't feel comfortable buying Bitcoin, but they feel comfortable getting Charles Schwab or some other broker and just purchasing some like Riot or Marathon or other stock. And for me, what I'm really thinking about, and I'd be curious to your thoughts on this, does this sort of break or have implications for the Bitcoin mining trade we've seen for two cycles now, where it's been a good time to purchase Bitcoin mining stocks during a bear market, and typically we see them go up like double-digit percentages going into a halving or post halving. And I'm wondering if that cycle might break or just be different this time around because of a possible Bitcoin ETF.
Yeah, I mean, so many layers to it, right? Like, it's funny. One of the comments that we or disclaimers we put in our research is, kind of all things equal, right? And so holding this constant, holding that constant, and there's so many different elements of it. You've got that make this, I think, cycle unique. You've got, the hash rate that we've talked about. There's been more hash or capacity added in the last 9 months than in the first 11 months of 11 years, 12 years of Bitcoin mining history, right? And so there's so many factors at play, um, and it's not just the ETF or just the price of BTC. So it's hard to say. One of the things, and I tell investors, and Will, you probably know this better than most people. When you look at, kind of where Bitcoin is held and where the addresses, that hold Bitcoin, a surprisingly small number of addresses hold a pretty sizable portion of Bitcoin. And, if you dig even deeper, what you'll notice is that of those small addresses, very few of those actually move Bitcoin. And so there's, I feel like there's conditions there because of how illiquid and how thinly traded Bitcoin is. When you overlay the ETF, like things could get really exciting or volatile just from the buying demand. Like, what do you have you given much thought to that? Just how thinly traded Bitcoin is and held.
Yeah, I guess my experience with it is looking at other crypto tokens and trading those, and those are even more liquid, right? You trade a little bit of it, and you see the price move so quickly if you trade something on Uniswap, like a new token. So to me, Bitcoin is like the big liquid token in the market that the price isn't going to move that much. But if you're comparing to like ETF markets or something else, then yeah, it's highly liquid.
Yeah. And the other thing is that the ETF could catalyze liquidity, right? And so it gives you another market to kind of to take a view in. And so ETFs in the past, so historically, typically provide liquidity to
hmm
markets.
Okay, let's move over to the report and talk about specifically. So you focus on four Bitcoin miners again: Cleanspark, Cipher Mining, Riot, and Marathon. Let's talk about some key metrics here that you thought were important for readers and analysts and investors to understand about these Bitcoin miners.
Yeah, so a couple things. Like I said, we've been covering this space for 2 years, and it's funny how um, how much the sell side has matured and evolved and um, gotten smarter on the space. So initially, I think if you look at reports from a year and a half ago, the way people would value these companies is they'd look at, obviously we're Riot and Marathon, which were the bellwethers of the industry. Like where are they trading on a hash rate basis? And what I mean by that, right? So how does the market cap of those companies, Riot and Marathon, what's the ratio or relationship between their market cap and their existing hash rate or their target hash rate? And you can use that formula to put a number on that, right? And so Riot and Marathon typically historically have traded at premiums to the other names in the space. And so the other companies in the space would say, hey, if Riot or Marathon trades 100 times their hash rate or 100 million times their hash rate, if you put that same valuation on my stock, it's worth 3x what it is today. And so that was kind of the base valuation metric, or paradigm or methodology. The problem with that approach is that and to be clear, that's a very common approach for most industries. And so, like, I cover fintech stocks, and we're always looking at what's the EBITDA multiple of this company, and why is this one trading at a discount or a premium, and can you narrow that gap, and what will be the catalyst to do that, right? And so that's a lot of people will make their investment decisions their views based on like that relative value. And so it's not a abstract or foreign concept. What's unique about Bitcoin mining, and you appreciate this, I'm sure, Will, is that it's a zero sum game. And so, a coin that I mine means that you can't mine that coin, right? And so it's not, um, it's almost like a scarcity mindset versus an abundance mindset, right? And so, because of that, if one company is more valuable, all things equal, so holding the price of Bitcoin constant and the network hash rate constant, then another company has to be less valuable. Like we can't all win, and so that was the flaw with the initial approach. What we've added with our report into the conversation is, taking a step back and saying, all right, what's the revenue opportunity in Bitcoin mining? And there are a couple of ways to kind of look at that. What we did was we said, all right, there are roughly 1.5 million coins remaining to be mined between now and 2040. And what are those coins worth today at the current price? And you can do that math. And as of last week, they were worth roughly $40 billion, right? We went back over time and looked at, what that value, how that's traded or trended over time. And I believe it peaked, let me check my notes here. That figure peaked at about 146 billion back in April of 21, right? And so in April of 21, the price of Bitcoin was higher and there were more coins to be mined. That metric has trended between 28 billion and 50 billion over the last 12 months. And so one of the important things that investors in growth stocks look at is, the first question is like, what's the addressable market? And that's a common question we get on any stock. Like, what's the addressable opportunity? And so taking a step back, the addressable opportunity right now, based on current Bitcoin prices, is $40 billion. If Bitcoin goes to 60,000 tomorrow, right, we would expect that number would double to 80 billion, right? And that would be positive for the entire industry. And so we started kind of with that number there, and we provide a chart in our report that shows how that's trended. We drilled down even deeper than that and said, all right, so that's the figure for the next, forever, from now until the end of the last coin is mined. What's the opportunity, the revenue opportunity based on current prices over the next 4 years? And so based on the schedule, the mining schedule, how many coins are going to be mined every year, the halving, and roughly 750,000 coins will be mined over the next 4 years. And then so the next question is like, so what are those coins worth? And using spot prices from a week ago, we tallied that at like $20 billion. And so that kind of frames the revenue opportunity. And I'd point out that 4 year horizon corresponds to the useful life of mining equipment. And so we thought that it made a lot of sense to look at it there. I mean, obviously, if you assume a longer life of the equipment, you get a slightly larger value. But we thought 4 years made sense. It corresponds with the life of the devices and the CapEx cycle. And so, like I said, $20 billion is the current 4 year block reward opportunity. For perspective, that figure peaked at $73 billion back in April of 21. I keep referencing these kind of peak numbers, but in theory, the stocks should trade um, or take their cues from kind of what the opportunity is. Like I said, this looks at things on a constant price perspective, and so like if you're bullish on Bitcoin, and you think Bitcoin is going to go to 100,000 or whatever it is, your view is going to be different, and this basically gives you a kind of a spot price type analysis. If you're bullish on Bitcoin, then these figures are going to be conservative. I'll stop there and let you ask some questions.
No, that was awesome. Yeah, that kind of crystallizes the opportunity for Bitcoin miners for the next few years. The other half of it, of course, is like, what are these Bitcoin miners doing to seize that opportunity? And the thing that I pulled out from your report specifically was efficiency of machines and efficiency across different miners. So we again went through 4 miners in this report, and you talked about the different joules per terahashes in all these machine fleets these companies have. And then you also combine that with energy prices to come up with
Sure.
like a more holistic view of the cost for mining Bitcoin for these different Bitcoin miners. Can you detail that a little bit for us? And then I want to return and talk about like how these two metrics, if you will, work together. The opportunity here with that $20 billion market, and then like the efficiencies and energy costs that the Bitcoin miners have.
Yeah, yeah. So no, that's a relatively new, kind of insight. And one of the punchlines from our report was that all hash is not created equal, right? And so um, even 6 months ago, I don't think the sell side research community really appreciated, some of the differences in the age and efficiency of the various miner fleets. And so, like as you mentioned, mining equipment is quoted efficiency wise in joules per terahash. And what that basically, the analogy I would compare is it's almost like fuel efficiency in a car, right? And so cars that have better fuel efficiency, you buy less gas, you spend less on gas. And taking that analogy further, if you're thinking about a Bitcoin miner, they essentially buy power and convert that um, into Bitcoin. And so if going back to the gas analogy, if you've got cheaper gas and a more efficient automobile, you're going to spend less on gas, and therefore you'll be able to keep more of your income. So you're not spending as much on gas. Same thing applies for kind of Bitcoin. What we found when we looked at the numbers closely was that there's a pretty wide variance between even in these 4 companies, like their efficiency in their fleets, and that's going to correspond to the models of miners that they're using. And so, at a very high level, of the 5 companies we cover, Cipher Mining had the highest joule per terahash, i.e., the lowest power efficiency of their fleet at 31 joules per terahash. On the flip, Cleanspark and Marathon were at 24 and 25. And so what does that mean, right? So that's one input variable. The second input variable is what are they paying for power? So while Cipher has the least efficient mining fleet, they're fortunate in that they've got the lowest power prices, and so they've struck contracts or deals with power providers in Texas, and they've got their average price per kilowatt hour is 2.7 cents. Most publicly traded miners are paying anywhere between 4 and 5 cents per kilowatt hour. And so Cypher is able to compensate for the fact that it has less efficient fleets by having a lower power cost. On the flip, Marathon, very efficient fleet. Their target efficiency ratio, once they put their next round of purchases in service, will be 24 joules per terahash, which is the lowest of the publicly traded companies. However, their power prices are closer to 6 or 7 cents per kilowatt, and so they've got a very efficient vehicle, but they're buying gas at the highest gas station in the neighborhood. And what does all this mean? It means lower gross profits, lower gross margins, lower profitability. And I'm sure we'll get into this, but it also is going to make it much harder to deal with a halving, which is going to happen in April of next year, which will essentially double everybody's power cost, holding all things constant again. So holding the price and the network hash rate constant. And so that was one of the things that we called out in our report, and it's really just, I like to say, we elevated the conversation in Bitcoin mining and added something to it. And so now it's not just about hash rate; it's about what type of machines are you running, and what are you paying for your power costs.
Awesome. Yeah. In your report, you called it a crucible moment for Bitcoin miners right now. I'm going to actually just hand it over to you, let you explain all that. I like that verbiage there, that phrase there, because I do really think that's how a lot of Bitcoin miners feel right now. Like, this is a time to get it
100%.
right. or
Yeah.
you're out of the business. So can you explain how that what that phrase means, the crucible moment,
Yeah.
and how that relates to both the opportunity, the $20 billion number we had earlier, and the efficiencies and energy prices we're just talking about?
100%. No, so and we haven't talked about this, but I'm sure your viewers, or maybe they're not aware of it, but there are a number of things going on. So obviously the hash rate, which is a measure of competition, has increased this year at a pace that we've never seen before. And that's really a function of a lot of orders that were placed back in 2021, when Bitcoin was trending a lot higher. And so you've had these companies that place these big orders, place these deposits. They're now receiving those machines and they're installing them. And so you've seen the hash rate continue to increase this year, despite the fact that Bitcoin, while up on the year, is still well below levels when these orders were made, right? And so higher network hash rate hurts profitability for everybody in the space, right? So you've got that as one kind of element. And it seems to be, um, not to be hyperbolic, but like the hash rate's almost on a runaway train right now. It just keeps increasing every month. And so that's one element. The second element, and we talked about it earlier, but the halving is essentially going to double everyone's power costs, right? And so what that means is if you've got less efficient equipment, it's gonna be painfully more less efficient after the halving. Like if your margins were 60% before the halving, they're going to be much lower than that after the halving. And so, um, with some of the uncertainty around both where the price of Bitcoin is going and where the hash rate is going, what you've seen is that a lot of companies, a lot of miners have kind of paused growth investment, and so they're kind of waiting. It's kind of a waiting see type of attitude right now, and this is compounded with the fact that the capital markets have somewhat soured on miners. And so, a year and a half ago, you could find debt financing to purchase miners and to build out infrastructure and data centers, and that funding is either much more expensive today because rates are higher and risk tolerances are lower, or it's completely gone. And so companies are having to kind of bootstrap their growth and self fund, and so you've seen high profile bankruptcies in the space like Core Scientific. And so management teams, particularly of public companies, are somewhat skittish about getting out over their skis and making big capital investments and big commitments right now without knowing where Bitcoin is going and where the hash rate is going. Now, saying all that, Bitmain just announced their new line of miners, the S21, which has not only record efficiency, but arguably record low pricing. And so you have seen a few companies selectively and opportunistically um, announce purchase agreements, in spite of or despite the fact that there's uncertainty in the market. But I think the price and the efficiency of those new Bitmain miners is compelling enough if you have capital to take a chance there.
Definitely. I mean, that $14 per terahash is pretty good stuff. What's
Very good,
yeah,
particularly with the efficiency. Like
mhm.
it's like that's going to give you. Yeah, I mean, there's you have a lot more, a much greater margin of error when you're running machines um, with sub 20 joules per terahash, and if you've only paid $14 per terahash, but you're in a good spot.
Yeah, definitely doing pretty well there. Let's go over to the four miners. Okay, so for Riot and Marathon, you were underweight, and then
Sure.
Cleanspark, you were overweight, and then Cipher Mining, you moved to neutral. Is from my
Correct.
understanding. Can you walk out what those terminology means for
Yeah.
investors who are just new to this space, and then also kind of give us some backdrop on why you selected those? Given, of course, that Riot and Marathon in the past have sort of been like the bellwether Bitcoin mining stocks people are
Sure.
choosing to purchase.
Yeah, so we use a relative rating system at JP Morgan. We have three ratings: overweight, neutral, and underweight. And what we try to do is balance our ratings. And so it allows us to make relative calls on different stocks. And so As you mentioned, we initiated an overweight on CleanSpark. We upgraded, separate from this note, we upgraded Iris Energy from neutral to overweight. We initiated on Riot and Marathon at underweight and Cipher at neutral. And let me kind of walk you through, kind of our thinking there. What stood out to us and why we liked CleanSpark was that it actually checked a lot of the boxes that we were looking for. So they had good hash rate, existing hash rate. So they had good scale to begin with, good operations, and we haven't talked a lot about that. But in terms of uptime and maintenance, they're one of the better performers in this space. And so not only do they have machines, but they're running those machines, and those machines are earning Bitcoin um, pretty well. The second thing, solid power prices. They're in the 4 to 5 cent range. Good fleet efficiency. And then I think most importantly, when you look at our profit forecast and where the stock was trading, none of that seemed to be reflected in the stock price. So it was one of the cheaper names in our space when you look at hash rate and you factor in all those things. It screened much cheaper than the other names. And so it seemed from where we sat that there was an opportunity, there was a mispricing in the market, and that CleanSpark represented a very good value. Similar with Iris Energy, another name that we've been covering. We upgraded those guys. Very similar profile. Good, efficient operations, good power prices, and the stock price was it screened very low relative to all of those things we kind of mentioned. Marathon, on the other hand, which we launched at underweight, I talked about it earlier. They've got the highest power costs in the space, 6 to 7 cents per kilowatt hours, which is easily 50% higher than most other companies, publicly traded miners, and that's a function of their business model. So they're one of they are the largest Bitcoin miner in hash rate, but they don't actually own and operate much of their capacity. So they outsource with a co-location provider. They do have a small vertically integrated operation in the Middle East, but that's very small today. The bulk of their stuff is outsourced through Applied Digital. And when you outsource, the benefits of that is that you don't have to build a data center, but there's no free lunch. And so the company that does build a data center is going to charge you a premium for that. And so they bake that into their power costs. What that means is that Marathon has lower margins. And it also means that if at the halving, assuming nothing changes dramatically with Bitcoin prices, that's going to squeeze their operations. And so they may, if the price of Bitcoin doesn't rally, they may be upside down on some of their contracts. And so that, combined with the relative valuation of the stock that didn't appear to reflect that, was why we were underweight those guys. Riot is a different story. They actually fundamentally check a lot of the boxes that we like. So they've got good cheap power, they've got good scale, they've got a big facility that's about to come online, so their hash rate's about to grow and double. So from that perspective, it's a great stock. They're positioned as well as anybody for the next halving. The problem was that that and then some was already reflected in the stock price, and so Riot far and away was the most expensive name in the space, and so that's why we were underweight those guys. One thing, and maybe we'll get into it a little bit later, but we establish hard price targets for our stocks, and the way we did that is we looked at their fleet efficiency, their power prices. So just to give you some perspective here of what we arrived at. We talked about Marathon having high energy prices, and when we did our math and we looked at Bitcoin price assumptions and our network hash rate assumptions, we calculated Marathon's 4-year gross profit per exahash based on their target hash rate and, again, their target efficiency and their power prices of 23 million per exahash. We took that value, we multiplied it by their target exahash, and then we made some adjustments based on their Bitcoin holdings and the probability of reaching their target exahash. And so that 23 multiple converted or translated to a $5 stock price for Marathon. Marathon, I don't know where it's trading at today, but at the time of our initiation, it was closer to $8. And so that's, how we got to that underweight rating. When we did the same analysis for Riot, like I said, Riot has good power prices, good efficiency, good scale. That figure for perspective was 51 million per exahash. And so Riot, based on current Bitcoin prices and our network hash rate assumption, is expected to earn $51 million per exahash in gross profits over the next 4 years. Applying that to the target gross profit to the target hash rate got us a stock price of 650, which is considerably below where it was trading. On the flip, you look at a company like Cleanspark and Iron. Cleanspark's profit per exahash gross profit was 51 million, which is in line with Riot. When we applied that, we got a price target of 550, which was well above the current stock price. For Iris, it was 46 per exahash, 46 million per exahash, and that got us a 650 price target. And so that's how we kind of arrived at our price target. It's based on the gross profit outlook for next 4 years, factoring in different power prices and joules per terahash. It's probably worth taking a step back and pointing out that my price targets are generally below other street analysts. And so you look at a lot of these names, the price targets are probably double what I have in mine. And I think, one of the key differences, or two of the key differences, are going to be, what's the network hash rate outlook? And I think that, most of the sell side is of the similar mindset that there's going to be some hash that comes off at the halving, and that hash rate growth will slow from where it is today. The other key difference would be, what's your Bitcoin price assumption? And I've seen some people that have, $70,000 Bitcoin price assumptions, $100,000 Bitcoin price assumptions. Our Bitcoin price forward outlook, what we did was we did an arbitrage-free pricing methodology. And so what that basically says is, all right, the price of Bitcoin a year from now, how could you hedge that out and predict that, right? And so what you can do is, if you bought Bitcoin today and you finance that with some type of debt, your carrying cost would be the appreciation that should be embedded in the price of it. And so, if borrow costs are 9 or 10%, if I buy Bitcoin today, I could essentially guarantee a price to you, Will, a year from now based on my carry costs and what my profit is. And so we use that methodology to kind of build out our forward curves for Bitcoin. Like I tell investors, like, our forward curve could be completely wrong. And in fact, it more than likely will be completely wrong. But that is basically where you could hedge out synthetically Bitcoin today. And so if the price of Bitcoins moves, our curve will move. But we will, in a rising market, we will systematically underestimate the price of Bitcoin. In a falling market, we'll systematically overestimate the price of Bitcoin. And so if you're bullish on Bitcoin, my price targets are gonna look very low to you. That said, the targets themselves do give you insight on, like, what's the best relative play. So, we can have different views on where the price of Bitcoin is going, but I can tell you that, if you think Bitcoin is going to 70,000, I think CleanSpark is still a better investment, because it stands to profit more from that move to 70,000 than a Marathon. And so, you can take, your own view on price targets, but, like, I would not underestimate or ignore the relative calls that we're making for you, because that's kind of where the alpha is in the trade, or where there are dislocations in the market.
Gotcha. I want to go back to something you said earlier, which was the energy costs. And something you put in the report, which I found interesting, was the breakdown between these different miners and their locations. So a Clean Spark is in Georgia, and that's a regulated market. So they have the ability to turn off purchasing energy, but they do not have the ability to be paid for turning off there. While in a
Mhm.
Texas market, someone like a Cipher or a Riot does have the ability to be paid for it. Marathon, with its asset light strategy, doesn't get any of this money, as of
Sure.
my understanding. Tell me a little bit about that and how, from an analyst perspective, you look at these future cash flows from energy hedging.
Yeah. So yeah, you're totally right. It is an element of some of their operations. Interestingly enough, these miners put out monthly data, and during the summer, a couple of them highlighted that they made, millions of dollars selling power back to the grid in Texas, and that didn't go over well with politicians and consumers and the like. And so they've we'll see, how forthright they are in advertising the benefit that they're getting from selling power back. Um, but ignoring that, there's definitely an opportunity there. What I would say is this: in general, I kind of look at that as kind of trading type revenue and profits. And because of how unpredictable trading is, you generally find investors and institutional investors do not assign as high of a earnings multiple on those types of cash flows because you just can't predict them, right? So they're, you may make money in the summertime, you probably won't make money in the wintertime, possibly, but because it's so unpredictable, you tend to assign a lower multiple to that profit pool, and so it's great. The way I would look at it if I were a miner is like treat those trading gains as windfalls, and you can plow that back into your capital investment, maybe buy more machines and get paid or rewarded for it that way. But it's hard to for a sell side analyst to kind of you know really put a lot into that. If that makes sense.
Yeah, I mean, it's so variable, right? Because you never know if it's going to be really that hot in Texas. I mean, you probably do, but you don't know if you're going to have to turn off. So that definitely
Exactly.
makes sense. So, sort of on like a similar adjacent topic here, energy credits, that's a bonus a lot of these Bitcoin miners have gotten from a strategy perspective. We've also seen a slight move to AI and HPC from a few of these miners. You mentioned Irene earlier.
Yep.
Any thoughts on that, on like the diversification aspect and how to account for that when you're looking at these Bitcoin miners? Is that a play that you're specifically interested in, or do you think the market's going to like look at that and be interested in it?
Yeah. So a couple of things there. Obviously AI and HPC is super hot right now. You look at the stocks in the stock market that have rallied this year. A lot of them have are plays on that, right? So it totally makes sense that um, these companies would try to fish that narrative or that exposure into their stories. Um, in addition to that, it's a lot easier to get funding for a data center that's providing AI and HPC processing than it is for a Bitcoin miner. And so from that perspective, it makes a lot of sense as well. Like you can actually go out and get a loan for that. You can sign some well credited tenant customers, and a bank or a lender will give you money to build out your site, and so that's helpful. Um, what we don't know is what are the economics of that, and so still very early days in terms of like what they can charge. My guess in listening to various earnings calls and management teams is that the major tenant customer is gonna have pretty good economics, and then they're gonna try to supplement that with kind of ad hoc work. But again, like it's unclear like what the cash returns are. I think the capex for some of the machines, depending on what you're doing, can be higher than Bitcoin mining. So there's a lot to kind of weigh, but it totally makes sense when you're thinking about it operationally. They have these miners have experience in running, high power consuming assets and developing these assets, and whether it's the power infrastructure or the data center infrastructure, like they're well versed in that, and so it makes sense strategically if you have power capacity that's idle.
You're a lot less skeptical than I am. When I look at these headlines, the first thing I think is like, oh, you're just trying to get more money or more interest on your stock, and that could be the case, right? I know you're
No,
not dismissing
100%. Like
that.
it is. I mean, like
Yeah.
if you look at there are metrics where different data services will kind of scan through transcripts and look for keywords, and like
Mm.
everybody's trying to weave AI into their earnings calls, and so it totally makes sense. I mean, it's investor relations is sort of like a corporate marketing function, and so you definitely want to, where possible and where applicable, you want to lean into those things. Now, I'll say this: like, I don't think anyone, certainly no one in my space, has of the five miners that I cover, none of them have put a huge stake in the ground and invested a lot. Like Iron is kind of dabbling in it, um, testing, right? And so
Yeah.
so everybody's just kind of testing, and they're going to see how it kind of plays out. But it makes sense, um, to me. And so
Yeah.
we'll see ultimately where it kind of where it goes.
Definitely. So while we're finishing up here, because we're reaching the top of the hour, I kind of want to finish off on a note about how these Bitcoin miners kind of relate to the public. Because, like we said a second ago, there is this history of volatility. There's also a history of marketing. And you also mentioned the monthly miner updates, which everyone sort of has like their own metrics that they like to tailor to their own operation. From an analyst perspective, from someone who's been looking at different stocks, and specifically in the payments world for 20 years, what are some things that need to professionalize? What are some things that need to be better in this industry so more people come into it and feel more comfortable
Sure.
uh, playing in the Bitcoin mining pond, if you will?
Yeah. So one of the things that stands out is, you know, like you alluded to, I've been covering stocks for almost 20 years. Um, to me, it's almost standard that companies have earnings calls where they take questions from analysts, and of the companies that we cover, the miners, like, it's not universal at this point, and so there's definitely an investor relations gap. I applaud them for providing the monthly updates, but having a quarterly earnings call where you're held accountable and you're asked and answered questions, I think would do a lot to increase confidence in the space and interest in the space from institutional perspective. So that's kind of number one. Uh, I think, and this is a question that I ask every CEO that I meet in the space, and that investors, particularly the ones that I deal with, are used to seeing charts that go up and to the right, and by that I mean revenue and profits are growing every year. You don't have that type of predictability with Bitcoin mining, because the price of Bitcoin can fluctuate, network hash rate. There's so many outside variables that can impact profitability. And almost to a man, every CEO that I've talked to acknowledges that and say, hey, our approach is we want to be the low cost provider. And we think the low cost provider ultimately wins out over time. And, I totally agree with that, certainly. Um, and it's a great relative position, right? But, equity investors like absolute gains, right? And so, um, that's an obstacle, right? And so, like, dealing with that, how do you manage through the cycle? And the space is still young, and so that story is kind of yet to be written. But I think the fact that profits are so volatile and unpredictable is something that kind of keeps some institutional investors on the side. And then the last thing um, is, how do these companies monetize what it is that they're doing? Right now, we're heavily in the invest stage, the capital investment stage, and so, or phase rather. And so, as companies are making profits, they're plowing those profits back into buying more devices, expanding capacity, et cetera, et cetera. At some point, this industry has to reach equilibrium where there's a profit pool and there's a capex, and so I think as you approach that point, you'll also get more institutional investor interest. because right now it's like, everyone's profits are basically being plowed back into um, investment. And one of the things that we kind of talk about in our note was that, we see hash rate growth, that is, slowing to about 50 or 60 exahash per year. Um, and it simply has to slow. Otherwise, you're always on this perpetual hamster wheel, and you're just running, and you're never actually getting anywhere. And so, that 60% basically corresponded to, we think that at some point the industry will say, all right, we're earning this in gross profits. We are comfortable reinvesting some portion of that back to CapEx, new devices, new data centers, things like that. But we can't just keep spending, kind of indiscriminately. And so, if I were to sum up the kind of three things in reverse order, like CapEx management, um, how do you manage through the cycles, would be kind of the key things there.
Awesome. What are you looking forward to over the next few months going to Halvening, and where can people continue to follow your work at JP Morgan?
Yeah, so I mean, we are spectators and fans of the industry. I'm curious to see where hash rates go, where prices go, if this ETF goes through. Um, yeah, and really like how the industry evolves, and then as the halving approaches and occurs, how much of that hash rate kind of comes off the network. And I mean, there's so much more that we include in our report that we didn't get to touch on today. I mean, it's a fascinating kind of space. It's funny, I've seen some of our reports or portions of our reports cited in various media publications. And so as we publish stuff, like, your typical media outlets pick up what it is we're saying and what we're thinking. And so, yeah. And I guess, Will, you can always have me back out in 6 months, and we can do this again and catch up on where things are and where they're going at that point.
Oh, you know it. I'll be hitting you up in the inbox soon. Reggie, thank you so much for joining the Mining Pod. It was awesome talking with you today.
Thanks for having us.